So let's do one thing. Let's talk about HealthCare Global. It's the next corporate on our radar. For Q4, the company reported a decent performance with a healthy surge in revenues, and the average revenue per occupied bed also went up. Their debt level has also declined, although Q4 occupancies were flat. BS Ajaikumar, the Chairman and Chief Executive Officer at HealthCare Global Enterprises, joins us now to talk about that. Mr. Ajaikumar, thanks a lot for joining us. You know, in the past couple of days, we've had a chance to speak to a lot of hospital companies, including names like Medanta, etc. And what we understand is that two factors worked in your favor this time, which was a rise in surgical revenues and a rise in international patients. But particularly for HealthCare Global, can you tell me what did these parameters look like, and what is the growth that you're expecting in the first half of FY24?
Yeah, our revenue, as you know, has been growing significantly year on year, even quarter to quarter has been growing. And regarding the type of revenue, we have shown that since most of ours is outpatient, and our revenue, we focus more on chemotherapy administered, radiation oncology, and surgery. All the three have shown a revenue increase of over 20%, which is, I think, is in keeping with what our expectation is. As well as our international market has shown a good rebound. You know, post-COVID, as you may all know, it was recovering. Now it has gone beyond the pre-COVID level, and we are very happy to report that and say that it will continue to grow as moving forward, because HCG has now become a destination for oncology, not only in India, but also for international patients. And because of that, we expect to see continued growth in our international market.
Mr. Ajaikumar, could you
give us
some numbers?
And going forward for this year, while we don't give numbers, we will see a similar healthy growth, even quarter one, quarter two, and we expect a growth in the region of about 15%.
Revenue growth of 15% in FY24?
Yeah, we expect a significant growth.
Okay, and what about margins, sir? Could you broadly guide us without being very specific?
Yeah, when we look at the margin, we divide between mature centers and emerging centers. Mature centers have a margin over 20%, and in fact, our center of excellence in Bangalore has a margin over 25%. Whereas our new centers, so-called emerging centers, have a margin which is in the lower, below 10%. But we expect these margins, as the centers become more mature, to go into the lower teens coming year. So overall, we expect the margin hopefully to reach around close to 20-21% in this coming year.
All right. Good morning, Dr. Ajaikumar. Nigel on this side. So I had a couple of questions, particularly on the emerging hospitals, out there. The emerging centers, the growth has been very good. You're clocking close to around 100 crores per quarter, which is good. The problem is on the EBITDA front. The first half of the year, you were doing close to around 10 crores per quarter on the EBITDA. That's come in a little bit lower. So what kind of revenues are we looking at from these emerging centers in FY24? I think last year you would have done roughly around 410, 420 crores approximately. And more importantly, what kind of margins can we look at? Low teens will be what? 12-13% should we be looking at for FY24?
Yeah. See, when you look at why the emerging markets are shown a high revenue, is because they start from the low base. And they are not, the base is lower compared to the mature markets, mature centers. So because of that, you see significant growth in the revenue. But obviously, because they have not hit a certain point where we start seeing good EBITDA margin, still the margin will be lower, because still they have become EBITDA positive and moving up the ladder. So coming year, we expect centers to catch up. And because of that catch up, as you said, our margins in the emerging centers will be reaching close to low teens. Somewhere in the region of about 13-14% is what we expect. And overall margin together with mature center reaching close to 20%.
Now 13-14% will be emerging centers, and revenues will be what? 475 crores? Should we work with some kind of growth for emerging centers itself?
Yeah, revenue 100 crores together for the whole year. We expect the revenue to be somewhere in the region of 475 to 500 crores.
Got it.
Okay. I wanted the average revenue per occupied bed, right? That's the internal which we track closely. I wanted an indication of how it would head from here, because in the quarter gone by, you've seen an 8% growth and you're almost at 40,000 rupees per day in terms of average revenue per patient. Can you tell us from this 40,000 rupees, how much can you scale it up to? What would the average look like in FY24?
See, we expect a normal growth in the ARPOB about somewhere in the region of about 6 to 8%, but it could also differ depending on the mix. Particularly our mature centers and center of excellence in Bangalore and in Ahmedabad show a significant increase in the ARPOB, somewhere in the region of 70,000. So I think with certain measures we have taken, even in tier 2, tier 3 cities, where we are bringing high technology, we expect the ARPOB to increase even in those regions. So it will catch up. I think it will come somewhere in the mid-40s as we move forward.
Mid-40s is in FY24, is it?
Towards the last quarter.
Towards the last quarter of FY24. Got that. Just one final question on debt reduction. And, would there be further paring off of debt? You've already done it quite a bit, and your debt is now at sub 200 crores, which is great. But any plans to reduce it further?
No, actually, we have done remarkably well. If you look at our capex, replacement capex and all we had, our debt has actually not increased at all in spite of the replacement capex. And that has been a significant improvement for us. So I think we continue to stay on this track, and moving forward, our debt will not significantly increase because we are also doing the pay-for-use model. And our capex debt, it will not come in the debt in our books. So with all these innovative measures we have taken, we expect to control the debt below 200, even with the replacement capex.
All right, Dr. Ajaikumar, thanks so much for stopping by. I think the takeaway from there is you're looking at improving your margins, and also in the emerging centers, you're guiding for 475 crores of revenues with margins at around 13% or thereabouts. Well, let's focus